Welcome to the deep dive. We're here again to sift through that huge stack of sources you've gathered, all the articles, notes, everything. Our job is to pull out the really crucial insights, the things you need to know. And this week, wow, the mission is synthesizing some really stark contrasts in the global markets. We're seeing these absolutely massive tech deals, just enormous sums of money flying around. But at the same time, you've got intense political clashes brewing and, well, fundamental economic uncertainty.
Yeah, the sources this week really paint a picture of a paradox, don't they? It's quite striking. On one hand, there's this almost, you could say, reckless, definitely insatiable appetite for next-gen tech. And for those really high-end exclusive assets, I mean, companies are throwing tens of billions of dollars at building, the infrastructure for tomorrow.
Just boundless confidence, it seems, in the long-term future of AI and automation.
Yeah, totally. But then you flip the coin, and the macroeconomic risks, the political risks, they're looming so large that people are piling into traditionally defensive things, like gold, pushing it to record highs. We're genuinely in this moment where you have profound enthusiasm and really pervasive, deep fear existing side by side.
Okay, let's definitely unpack that. The sources are basically yelling two opposite things at us: record valuations and fundamental fear. So I guess we have to start where the money's flowing fastest, that AI infrastructure arms race.
The scale is just, it's almost hard to wrap your head around. Just this week, CoreWeave and OpenAI expanded their agreement, another $6.5 billion deal. That brings their total contract value, just between those two, up to $22.5 billion. That's real money committed to cloud and compute power for AI.
22.5 billion just for AI cloud infrastructure. Incredible. And it's not just happening in the US, right?
No, it's absolutely global. Look at Nscale, a UK firm focused on AI data centers. They just raised a huge $1.1 billion Series B. And that round, it was led by Norway's Aker. But look who else is in there. Nvidia, Nokia, Dell, real heavy hitters. And this money is specifically to fuel the rapid rollout of AI infrastructure. They're even talking about projects linked to OpenAI's, well, pretty secretive Stargate initiative in the UK and Norway. It really feels like a multinational push to build this shared foundation for the AI age.
Okay, but here's where it gets really interesting. Like you said, the paradox. You have all this monumental spending, but then you look at the stock market's reaction, and the skepticism is palpable.
We definitely saw that. Nvidia and Oracle stocks both had multi-day declines. And the commentary pins it directly on what analysts are calling heightened fears about the potentially circular nature of the AI industry.
Okay, explain that a bit more. What does circular nature mean for you listening?
Right. It basically means that a lot of this huge revenue, like that massive CoreWeave OpenAI deal, it's generated by companies selling capacity to other companies who are often, at the same time, their key partners or even customers. So analysts are worried. These huge revenue numbers, they look fantastic on paper right now. But if this sort of speculative cycle slows down, the foundation underneath those revenue streams might be, well, less stable than it looks. The whole sector is really relying heavily on this internal ecosystem of spending.
And that uncertainty, that fear, is leading to some serious warnings. Rothschild Redburn actually initiated coverage on Oracle with a sell rating. They're predicting a potential 40% drop. Their argument is the market materially overestimates the real boost Oracle gets from these AI deals. That's a pretty loud caution flag right in the middle of all this infrastructure excitement.
It is. And yet, the actual application of automation continues nonstop, which shows you why the enthusiasm exists in the first place. Take a look at Light, a Danish startup. They just raised $30 million for software that automates accounting, bookkeeping, financial reporting, all that stuff. And their CEO said something quite powerful. The future of numbers is text. That's AI hitting core business functions, delivering the efficiency gains everyone's betting on.
And meanwhile, the big global players, they're still forging ahead with development despite any stock market jitters. Alibaba's boosting its AI investment by, 380 billion yuan? That's around $53 billion US. And they just rolled out their biggest language model yet, Qwen 3 Max. So yeah, the race itself certainly isn't slowing down. Okay, so if extreme investment is the theme in AI, then maybe resilience is the word for the U.S. job market right now. Let's shift gears a bit. Looking at the macro signals, they suggest strength, but there's definitely still this undertone demanding caution.
Yeah. The resilience is clearest, as you said, in the labor market numbers. Jobless claims took a surprising tumble, down to 218,000. That was quite a bit below the 235,000 estimate, which helped calm some recent nerves about, underlying weakness in jobs. And on top of that, we saw a pretty significant upward revision for Q2 GDP, gross domestic product. jumped pretty sharply to 3.8% annual rate, up from the earlier 3.3% estimate.
And wasn't that GDP bump mostly consumer spending? Meaning, even with inflation concerns lingering, people generally feel okay enough to keep buying things?
That's right. Consumer spending was the main driver, so employment looks solid, consumer spending, that's generally positive. But then you look at something like residential real estate, it's acting like a brake, almost. Existing home sales were totally flat in August, just stuck at an annual rate of 4 million units. And this isn't because demand suddenly crashed, it's more about a severe lack of supply.
Right, because nobody with a 3% mortgage wants to sell and buy again at 7% or whatever it is now.
Exactly that. And look at prices. The median existing home price hit $422,600. That's up 2% from last year. And that marks the 26th month in a row of annual price gains, even with these high mortgage rates. So you've got high prices, stalled inventory, few transactions. That's the housing picture right now.
And speaking of caution, we heard from the Federal Reserve too, right? Adding to the jitters?
Absolutely. Fed Chair Jerome Powell came out and explicitly said, quote, equity prices are fairly highly valued. Now, when the head of the Fed says something like that, especially with all the global political uncertainty swirling, investors listen. And they often react by moving quickly into safe havens, which explains perfectly why gold, the classic counterasset, just surged, hit a record high above $3,700 an ounce. It's gained over 40% just this year, fueled almost entirely by this mix of political and financial uncertainty.
Wow, 40%. So for you listening, if you want to diversify a bit against this fear, what's the practical way to get some gold exposure?
Well, the consensus advice, typically, is to look at gold bullion-backed ETFs, exchange-traded funds. Things like GLD or IAU are common ones. You can hold them as part of a broader diversified portfolio. But here's the key caveat. Moderation. Experts strongly advise limiting gold exposure. Keep it under, say, 3% of your total portfolio. Think of it more like an insurance policy, not really a core investment strategy itself.
That makes sense. And we're seeing these extremes play out globally, too. Japan's Nikkei hit a new record high. But then you contrast that with the potential risks brewing in China.
Yeah, in China, analysis from Barclays points to this anti-involution campaign. And they think it could actually slow down investment and growth there. Now, involution, for you listening, it basically describes this really intense, often non-productive cycle of extreme workplace competition and overwork. Burnout culture on overdrive. So the government campaign is aimed at cracking down on that kind of extreme environment, which might sound good for workers, but Barclays' take is that slowing down that intense competition, even if some of it seems wasteful, might paradoxically slow down investment and tech development too, leading to, well, slower overall economic growth. It's a tricky balance.
Okay, let's move into the corporate world now. Here again, we see these really clear divides. You've got established companies restructuring, tightening belts, and then you've got certain exclusive assets just exploding in value, seemingly detached from everything else.
Yeah, let's start with the restructuring side. The tough realities. Starbucks announced a huge $1 billion restructuring plan. They're calling it Back to Starbucks. What it means in practice is closing about 1% of their company-run stores in North America and laying off around 900 non-retail employees. So they're essentially cutting back on non-store staff and maybe some underperforming locations to pour everything back into improving the core customer experience in the cafes.
And we saw other traditional companies get punished pretty swiftly when they missed expectations. CarMax stock just plummeted, right?
Yeah.
More than 20%, after missing Wall Street's earnings and revenue numbers in what they themselves called a challenging quarter.
Exactly. And similarly, look at Transocean, the offshore driller. Their shares fell 14%. Why? Because they had to offer a huge chunk of new shares, 125 million of them, at a steep discount just to pay off debt. So these are kind of traditional industries facing real headwinds, needing some drastic moves just to manage their finances.
Okay, but then you step into this almost parallel universe of asset valuation. The Chicago Bears NFL team, valued at a record $8.9 billion. That's based on a minority stake sale to existing owners. And the key context here, this is insane. That valuation is up from $6.4 billion just 1 year ago.
It's phenomenal growth, isn't it? Just
Yes.
exponential. And it really highlights the soaring value of scarcity, yes, but maybe more importantly, the escalating value of live media rights. The NFL is just seen as irreplaceable TV content, must-have programming.
And sticking with the NFL and media, we saw Commissioner Roger Goodell basically wave away conflict of interest concerns about Tom Brady. Brady's got this dual role now, national broadcaster for Fox and also a minority owner, like a 10% stake in the Las Vegas Raiders.
Right. And Goodell dismissed the concerns. It suggests the league is prioritizing, The star power Brady brings to broadcasting, and maybe the overall asset valuation boost over those more traditional conflict worries. And then on the distribution side of media, there's a big fight brewing that could affect millions of you watching TV. YouTube TV, huge platform, about 10 million subscribers. They're reportedly on a collision course with NBC Universal over how much YouTube TV has to pay to carry NBC's channels.
Uh-oh. Could that mean a blackout?
Potentially, yeah. The report suggests YouTube TV is taking a really hard line, pushing for lower fees. These disputes can get ugly, and sometimes channels do go dark for a while.
And then there's that really complex situation unfolding at Disney. It perfectly illustrates how political pressures can clash directly with business decisions, or at least perceived business duties. You've got a group of Disney investors demanding access to internal company records.
Yeah, their argument revolves around the suspension of Jimmy Kimmel. They claim that decision put political pressures. They mentioned specific threats from federal regulators and affiliate stations ahead of the company's fiduciary duty to its shareholders.
Okay, unpack fiduciary duty for us quickly.
Sure, it's a legal and ethical obligation. Corporate leaders have to act solely in the best financial interests of the shareholders, the owners of the company. And these investors are pointing out that Disney's stock fell 3.3% right after Kimmel's suspension. They're essentially saying, look, this political decision hurt our investment, and we think you prioritize politics over profit. They want to see the internal discussions.
Got it. And finally, just to really hammer home the global political instability that's kind of the backdrop for all these market moves, former French President Nicolas Sarkozy was just handed a 5-year jail term for criminal conspiracy related to dealings with Libya.
And it's a stunning sentence, enforceable immediately, even if he appeals. It just underscores the incredibly high stakes in politics globally right now, whether you're looking at business impacts or government actions themselves.
Okay, let's pull this deep dive right back to your immediate world, your finances, and how government policy is directly impacting households. The potential government shutdown feels like maybe the most pressing threat right now.
Absolutely. The Office of Management and Budget, the OMB, they've actually ordered federal agencies to prepare for issuing reduction in force notices. Now, that's bureaucratic language for essentially mass firing preparations. If Congress doesn't manage to pass funding and avert a shutdown by next Tuesday night.
That sounds more serious than the usual furlough threats.
It does. In past shutdowns, workers were typically furloughed, meaning temporarily sent home without pay. This threat of actual permanent job losses, well, it definitely raises the stakes for federal workers and, for all the services they provide to the public.
And at the very same time, we're seeing huge problems, real turmoil in some critical financial safety nets, specifically student loans. The income-based repayment plan, IDR, seems to be facing really severe issues.
Yeah, IBR, income-based repayment. It's a lifeline for many. It allows borrowers with lower incomes to eventually have their remaining federal student loan debt forgiven after making payments for 20 or 25 years. But that forgiveness part, it's temporarily frozen, on hold, until winter 2025. And that's because of court actions tied up with the newer SAVE plan, the Saving on a Variable Education Plan.
So legal fights over the new repayment plan are actually freezing relief under the older established plan.
That's exactly what's happening. And it gets worse. There are reports showing borrowers are being wrongfully denied entry into the IBR plan itself. This is happening despite a new law that specifically removed the old partial financial hardship requirement. That rule change was supposed to make it simpler to get into IBR.
Wow.
So yeah. One of the main remaining paths to potential student loan relief is effectively broken right now, tangled up in bureaucracy and legal fights.
Okay, but amidst that bureaucratic mess, there was actually a small piece of good news on the financial aid front.
There was, yeah. A small positive step. The FAFSA form, that's the main application for federal student aid for the 2026-27 school year, it was actually released a week early. And experts are calling that a huge win. Why? Because filing the FAFSA early significantly boosts a student's chances of getting certain types of financial aid that are limited and tend to run out.
First come, first served on some aid.
Exactly. So that little bit of government efficiency, releasing the form early, can genuinely make a life-changing difference for some students and families. Now, contrast that whole experience, the broken IBR, the slightly improved FAFSA, contrast that with how policy works for high-net-worth investors, where government policy seems to be working exactly as designed to encourage specific investments. Look at the high-end racehorse market. It just saw a record $531.7 million in gross sales at the Keeneland September sale. Absolutely massive numbers.
Okay, what on earth drove that kind of spending on racehorses?
Well, a huge part of that boost is attributed directly to the permanent renewal of 100% bonus depreciation. This is a really powerful tax break put into law that lets owners, typically high net worth individuals, write off the entire purchase price of a racehorse against their income in the very first year they buy it.
The whole thing, immediately.
The whole thing, 100% in year one. It's a massive incentive designed specifically to spur investment in assets like racehorses. And clearly, judging by those record sales, it is working spectacularly well in driving up valuations in that specific niche market.
That is definitely a powerful incentive. All right, finally, let's do a quick check on just basic personal financial planning for, well, for everyone else, which feels more urgent than ever given all this uncertainty.
Yeah, the data is pretty sobering. Almost half of Americans, 47%, report they do not have a written financial plan. So if you're out there listening and thinking about seeking advice, the key piece of wisdom from the experts is this. Interview at least 3 different financial advisors before choosing one. And specifically, try to prioritize advisors who hold the CFP designation. That stands for Certified Financial Planner.
Why is that CFP designation so important? What does it guarantee?
Well, the crucial thing is it requires them to adhere to a fiduciary standard, a fiduciary duty. That means they are legally obligated to put your financial interests ahead of their own, ahead of potential sales commissions or selling you products you don't need. Also, make absolutely sure their compensation model, how they actually get paid, is simple and totally transparent before you agree to anything. You need to understand exactly how they make money from advising you.
Okay, so wrapping this all up, what does it all mean? We've surveyed this landscape where, AI is driving these multi-billion-dollar deals for infrastructure, it's automating corporate finance, promising huge efficiency gains across the board. But then, at the exact same time, fundamental systems that people rely on, like student loan forgiveness, seem completely broken, failing because of complex bureaucracy and endless legal challenges.
I think that's the core takeaway. The pace of technological investment is just staggering. It's creating immense asset values, whether that value is tied up in, cutting-edge AI chips or in irreplaceable NFL media rights. Huge sums are being generated. Yet at the same time, many of the really crucial financial safety nets, the mechanisms designed to help ordinary Americans navigate life, things like smoothly functioning government services, reliable student relief programs, they seem to be struggling. They're under threat of political shutdown or just simply non-functional because the systems themselves are flawed.
That contrast leaves us with maybe one final provocative thought for you to mull over. If AI is getting so good, so fast at perfecting the automation of complex corporate finance and data management, to the point where that CEO can confidently say the future of numbers is text, then why are these crucial, genuinely life-changing government processes, things like the IBR student loan forgiveness pathway, still stuck? Stuck in systems apparently so complicated and, frankly, broken that they need constant intervention from Congress and the courts just to halfway function. What essential human element or perhaps failure in implementation and priorities are we missing in this relentless rush towards automation everywhere else? Something to think about.